definition questions.
Did you write the numbers or does it?
Do you have two definition questions?
Also there. I'm not sure. I think what was another call? So you definitely. Okay. Anyhow, what would be your? Yes. Yes or no? Yeah. Yes or no? Yeah, this is wasn't slide, but I'm not sure.
She was in neuroscience maybe.
I mean, but it wasn't really exactly the same, so that's why we moved. Yeah.
Do you have any definition questions? All of them are like calculated question.
I had only one that can be a
Really? Oh, I only have one, but I have two definition questions.
like,
Yeah, I have two definition questions.
like what?
One is about, I think it's about central theory. One is about
I had like
oh, yeah, that, I also have that, but like that's not definition question.
So you got 11, Chris?
I had one of this.
I got 11 right, but there was, remember those management questions, the really easy
I
ones?
just don't know which question.
I got it wrong because it said the first rejection they were used the previous round.
I just have no idea.
All these like just for practicing.
So what did you guys get?
I got a guess, and I guess it was no. Or what did you guess?
Well, he's gonna do a retest, so.
Yeah.
I don't even think it's that bad of a score.
All questions inside out.
Yeah.
Really? Share that.
Sure.
Question, figuring out which one.
Okay, I will do that in the break.
Okay, that's fine.
So you're gonna-
I didn't really, I would need it, but.
Yeah, bro.
I'm just trying to do it.
Yeah, this will be a text mark.
Yeah. Bro, and it was pretty, like, it was kind of serious things too. Like, I know people like us. Yeah.
Alright, so I know I got the true or false wrong. I know that I got the, you remember the one where it was the three variables?
Yeah.
So 1, 2, 3, I know I got that wrong.
Yeah, I got that.
Yeah, well, I got all the, that didn't make sense.
I was like, bro, what
Didn't make sense.
I went away with her.
Hey, let's begin. So first of all, there's this event organized by the FERM program. So everyone is encouraged to participate. This is from November 3rd to 4th in stores, which is a little bit far from here, but I guess this is kind of the best season to visit stores, the main campus. There are still 2 copies of the homework one that this you should, who's Reese and Ziyi Pan and David, you should get your homework back, and see if you find any problem with grading the other one.
Oh wait, I think it's a.
The other one?
Yeah, Grace
Oh,
was
okay.
yeah, thank you.
How about David? No, okay. So,
Didn't they say they were gonna run a bus from here up to there for this? Wasn't there an email about that?
yeah, you can check my email. I don't remember.
Well, somebody else has sent it, so I wasn't sure.
Not sure. I'm reading I read the email. I didn't find anything there, but
About this event,
Yeah.
he sent an announcement.
yeah, there
Yeah.
is an announcement, so you can
This
read that
afternoon.
announcement, I guess.
I live halfway in between here and the store, so
Okay.
some people may live on this part of the state.
Okay, so we are going to finish the Greeks, and we will talk about value at risk. So we talked about several Greeks. The most important one is delta, which I explained, and then we talked about vega, gamma. Okay, so delta matters for the small movement in stock price, which is very often and the gamma basically captures, if you want to not just hedge the small movement in stock price, but also want to hedge large movement in stock price or underlying asset price, you need to make your portfolio gamma neutral. And if you want to have zero exposure to volatility risk, you want to make your portfolio vega neutral as well. This was an example. I think we went through this example. So it's basically you're going to create this portfolio, which is delta, gamma, and vega neutral. You basically can solve, you hedge make your portfolio gamma and vega neutral by using these 2 options. And then you will find that the delta of your portfolio is no longer 0, so you have to trade the underlying to make the portfolio delta neutral again. Now, the other question that I got is, after your portfolio is delta neutral by trading the underlying, what about the vega and the gamma of your portfolio, right? Because other than these 2 options, you also trade the underlying. So it seems like if you trade the underlying, that could change the gamma and vega of your portfolio. Is that true?
Yes.
No.
I had a
So my own
50-50
question.
shot.
The gamma and vega of the underlying is 0, because underlying is a linear product of itself, and the gamma and vega of a linear product is 0. So when you trade the underlying to make your portfolio delta neutral again, it is not gonna change your gamma and vega. You're still gamma vega neutral, so you're fine for that. Okay, the fourth one we'd like to talk about is theta. Theta is not really a risk measure. It is the changes in the price of your portfolio with respect to change in time. So here you basically assume, whenever we talk about Greeks, we assume that everything else remain the same. So when we talk about the passage of time, we basically assume that stock price doesn't move. There's no change in stock price, there's no change in volatility, but only in the passage of time. What is going to be the impact on your portfolio value? So that's why we call it, mathematically, this is called a partial derivative. So that is called theta. Theta is not really a risk measure because the passage of time is not a risk. There is no uncertainty there. From today to tomorrow, there's going to be 24 hours, so there is no uncertainty in terms of passage of time. Therefore, theta is not a risk measure. It's just people just like to use it to describe the increase or decrease in the value of portfolio with respect to change in time. For example, theta of a call and put is negative, which means that if the stock price doesn't move and the volatility doesn't change, even just passage of time, if you hold a call or put, the market value decreases over time. You can imagine that this is an option, right? So as you're getting closer to the maturity, the value of the option is going to be less. It's going to decline. So this shows you the theta of an option. So it's you can see that it's basically negative unless you're very close to, unless the stock price is very close to zero. Okay, the theta is greatest for the ATM options. There's no such thing called theta neutrality because it's not a risk, so you cannot hedge it. This is a time decay of your portfolio. It's deterministic, so there's no risk here. But many traders still regard theta as a useful description for descriptive statistic for portfolio. There are some other Greeks like rho, which is mainly used in exchange rate, foreign exchange. Okay, it's measured as a derivative with respect to changes in interest rate in a particular country. So if you have currency options, you're going to have two rows, one for domestic, one for foreign. So row measures the interest rate risk for these derivatives. So this table summarizes all the Greeks that we went through. So let's look at this. So for example, you have a single option, say, well, you usually need a model to solve for all these Greeks. For example, you can use the Black-Scholes model, which is a standard model. These days, they basically, the model basically provides you formula for all these different Greeks. Okay, you can directly, all those nowadays are programmed, so you can directly use those programs. They're going to tell you what is your delta. So basically, as an option trader, if you have like a computer, like they're going to tell you your option price, the delta of your option, gamma, vega, theta, all these different Greeks of those options. So you can directly see from your monitor. They calculate using some option models. Okay, so for example, there is a single option which market price is $2.40. Delta is 0.522. So we can interpret this number. So it basically means that if the stock price increase by $1, the value of this option will increase by $0.52. So that's what delta is. So when you look at this number on your monitor, you should have some idea about what is the economic meaning of this number. Basically means that stock price increased by $1, your option value increased by 52 cents. But if you take a short position, you need to add a minus sign in front, which means that if stock price goes up by $1, if you short position of 100,000 options, this is going to be the corresponding change in your portfolio value. For gamma, if gamma is basically the changes in delta, right? So if the stock price increase by $1, your delta will increase by 0.06. If you take a short position of 100,000, then that's the number. Vega, which this basically means this is per percent, which means that if the volatility of underlying assets of the underlying increase by 1%, your option value will increase by $0.12. Theta per day, if there's a passage of day, even without any other changes in the stock price or volatility, your option value will decrease by about 1 cent. If interest rate increased by 1%, your option value will increase by about 9 cents. 9 cents. Okay. So that's.
You said the most important is the data. Right?
Yeah, that's the most important one. That's what we call the first order effect. The rest are second order. Unless you take a very special kind of position in those options. For example, if you use like the straddle that we talk about, probably your first order effect is vega because you're basically exposed to volatility risk. In most cases, delta is the most important. It's the first order effect. Now, so in the previous table, we basically assumed that there's only stock price change or only volatility changes. What if all those multivariables change at the same time? That's kind of the normal daily case. Okay? So all these variables actually change simultaneously. How do we capture the changes in your portfolio value? We can also approximate your portfolio value change with respect to changes in stock price, change in volatility, change in interest rate, etc. So we can do it as well. But we're basically going to use this Taylor series expansion. So you can forget about the second line. Okay, this is just the full version of the Taylor series, but usually we can drop this and keep the first three terms. So if you look at the first three terms, so the left-hand side, delta P is the changes in your portfolio value. Okay. The first term, you can see that this is delta. PS is the dollar change in your stock underlying, and this is theta times the change passage of time. The third term is gamma times the changes in stock price to the square. Okay. So you can see that basically you can if you calculate your portfolio theta, delta and gamma and theta, you can approximate your portfolio value change with respect to the changes in stock price and passage of time. This equation does not include volatility, but we will include the volatility in next slide. So let's talk a little bit about the gamma in this case. So if you think about that, for example, this is a very So this is a case in which delta is neutral. It's a delta neutral portfolio. So you basically delta hedge your portfolio, but your gamma is not zero. The reason for that is, as I explained, that delta hedge is pretty straightforward and first order because you just trade the underlying. Usually the trading cost is lower, but gamma hedge, gamma neutral is harder to achieve because you have to use nonlinear products such as options. So for a trader, usually what they do is they're gonna maintain delta neutral on daily basis, but they may not be able to make their portfolio gamma neutral. They're gonna have some significant gamma, which is different from zero. Could be negative, could be positive, but here we can take a look at what is gonna be the impact on the portfolio value. Okay, so we assume delta neutral, but there is a little bit, gamma is not zero, basically. So from the previous equation, from the previous Taylor series expansion, just to focus on the first line, if you have a delta neutral portfolio, this is zero, this is theta, and this is gamma. So these two, the second and third term remains, so we have this equation, to simplify it. Now you can see the impact of gamma. Don't forget about we can also ignore the theta term because there's nothing we can do about it. And now the gamma term. Now you can see that if you look at the gamma term, you can see the change in portfolio value is in fact a quadratic function of the changes in stock price. And if gamma is positive, the change in portfolio value as a function of the change in stock price is going to be following the left side of the picture. If gamma is negative, we will have the portfolio value with respect to change in stock price will look like the picture on the right. What this tells us is that if you have a positive gamma, if stock price moves a lot, if there is a large volatility in stock price, actually that's going to improve your portfolio value is going to increase. You're going to benefit from that. But if you have a negative gamma, large moving stock price, it's going to significantly decrease your portfolio value. Okay? So when you look at your gamma, you can clearly see whether you're going to benefit or lose from this large movement in your underlying when you have a delta neutral portfolio. So obviously you will prefer to have a positive gamma in some sense. Okay, now let's include the volatility term, the vega term. Again, this one can be ignored. We can focus on the first four terms. The first term is delta, the second term is vega, theta, and gamma. So there's an extra term here, which is the vega term. Now you can approximate your portfolio value with respect to not just the move in stock price, change in stock price, but also change in volatility. And you can also, from this equation, you can also see that, right, if I have a portfolio which is delta neutral, vega neutral, gamma neutral, my portfolio value will remain even if there is a change in stock price or volatility. And we don't really care about how much the stock price and volatility will change because your portfolio is not going to expose to those risks. But you can also basically approximate the takeaway from this equation is that you can approximate the change in your portfolio value when you when you have certain move in stock DS and D sigma, which is changing volatility, once you know all the Greeks. In practice, ideally, traders should rebalance their portfolio very frequent to maintain zero delta, gamma, and vega. In practice, this is impossible because of transaction cost. Traders usually ensure that their portfolio are delta neutral at least once a day. Especially if you have this linear product, you're fine because once you set up your trade, hedging portfolio, you're good. You can hold it to maturity. That's the point of a linear product. The only issue is always about this non-linear product. So once you have a portfolio of non-linear product, so you have to keep rebalancing your portfolio, making sure your hedging portfolio, making sure that your delta, vega, and mega are neutral. You have to do this very frequently. In practice, they do delta neutral once a day because hedging down the line is relatively straightforward. Once there is opportunity arises, for example, you notice there is an option that can significantly reduce your gamma and vega, you're probably gonna go for it. So improve gamma and vega, this option is usually very hard to find. Once you find the opportunity, you're probably gonna at least lower the absolute value of your gamma and vega. But your portfolio will become larger. The hedging can be hedging per cost per each contract can be less expensive because many of these options can hedge each other. Okay? So once you have a big portfolio, you just need to calculate the total delta, vega, and vega, the total Greeks of the portfolio, and hedge that. So you don't need to hedge contract by contract. So lastly, we can talk a little bit about the scenario analysis in this case. Instead of just monitor the risk of delta, gamma, vega, option traders can also carry out a scenario analysis. So for example, there is this option position on foreign exchange rates. You basically calculate your portfolio value for these different scenarios in the exchange rates and these different scenarios in volatility. You can get a rough idea about the underlying risk. Okay, the maximum loss you can take here is -90 when exchange rate is 1.06, the volatility is about 12%. Okay, so today we mainly going to talk about value at risk and expect shortfall. So here is my plan for the rest of the lectures. So first this week we will talk about value at risk. Next week we will do historical simulation, which is we're going to estimate value at risk, expect shortfall using spreadsheet, using Excel. Let me check my account. Yes, so we will go through a spreadsheet example of estimating the value of risk and expect shortfall using some financial data. So next week, it would be great if you have a laptop. Please bring your laptop to the classroom so we can go through those spreadsheet together. And then the week after, we will talk about Basel 1 and 2, which is this bank regulation, the framework, international framework for bank regulation. And we will talk about Basel 3. which is the one that which is the regulation framework after the 2008 financial crisis, and then we will have some kind of final review. Okay, so let's start with the value risk and spectral. So these are two very, very important concepts for the foundation of risk management in financial institutions. So we went through, we talked about GRICS. GRICS basically quantify the exposure to a particular market variable, as you see, right? Different stock prices, different volatility, interest rate. But there are hundreds of market variables. A huge number of these types of risk measures are produced each day. They're usually useful to traders because traders only focus on a specific market. For example, you're a stock trader or you're a foreign exchange trader or fixed income trader. So, but they are not very useful for senior management or regulation. So that's why they invented value at risk in the expectation form, are basically attempts to provide a single number to summarize the total risk of a portfolio. So basically you want a single number that can tell you the total risk of a portfolio, rather than in GRICS, you basically, for each market variable, you're gonna have an estimate, have a number. So there are so many numbers there. Manager doesn't want to look at the hundreds of numbers. They want a single number. So what is value at risk? So value at risk is a loss. How much is a loss? I guess if you intuitively, it is kind of tells a manager what is the potential maximum loss of their portfolio, of their asset, for example, the maximum loss. Well, theoretically speaking, the maximum loss is infinity. But if the manager wants a number, not an infinity, which is useless, so you have to give them some statistic, a number, a maximum number in statistical terms. Okay, that's what we call the value of risk. So once, right, with that intuition, now let's try to define mathematically. So we are X% certain that we will not lose more than $V in time t. Okay, so this is kind of a maximum loss in statistical terms. So V is the value out of the portfolio. V is the function of 2. Basically, it's going to be mainly, it's going to a function of two parameters. One is the horizon. First, you need to tell me the horizon you're looking at, like 1 day, 3 day, or 10 day. It could be, if you really worry about the risk in long term, you can think about like 5 years or 10 years. Okay. And usually this X is called confidence level. X is a very big number. First of all, it's 95, 99, or 99.9. So you can see that X is a number that's very close to 100. So therefore, 100 minus X is going to be very, very, very small. So there is very small. If you want 100% sure, then I can tell you that the maximum loss is infinity. But if you just want to like 1%, 99% sure that my loss will be less than a certain number, I can give you this value at risk. Okay? And 99% sure that our loss is going to be less than this value at risk. So most likely, loss of this portfolio should be less than V. Then the V is called the value at risk. Okay. In order to understand this more we need to go through this these functions, this PDF and CDF, so that you understand more deeply about this mathematical term. So there are, for any distribution, there are these two functions that describe a distribution. One is called PDF and the other is CDF. So let's start with CDF. So CDF is f equals the probability of a random number less or equal to capital X. So small x is a random number. X is a number, and the capital X is a number. So capital X is given, basically a given number. So the CDF captures the probability. CDF is called cumulative distribution function. Captures the probability that a random number is less or equal to a number. So if that's the case, that's called the CDF. Let me ask the question, what is f minus infinity?
Probability of x is less than or equal to negative infinity.
So what's the
It's gonna be 0.
0? Because this is probability that a random number less or equal to 0, and a number will never, right? Any real number, minus infinity. So any real number is not going to be less than minus infinity. So probability is 0. How about f plus infinity?
One.
1, right? X is less or equal to plus infinity. It must be equal to 1, because for any number it's going to be less or equal to plus infinity, any random. So given that this is, so the CDF is going to be between 0 and 1 because it's a probability. So start with 0, and if you increase the x, increase capital X, it will converges to 1. And based on CDF, we can define PDF. PDF is the density function. You can define it as a small f. It's going to be the first order derivative the CDF. So what it means is basically you can see that f dx is going to be df capital X. According to definition, so D capital F is going to be the changes in capital F, and hence plugged into the definition of CDF. So that's gonna be the difference between the probability that this small x is less or equal to capital X plus dx minus the probability small x is less than x. In fact, this is gonna be the probability small x is greater than capital X and less than capital X plus dx. In this region. So this is what we call density, because this density times the changes in x represents the probability that small x is in this region. Or if you think about a normal, for example, for a normal distribution, this is the PDF. So this number is the fx. And think about this small rectangle. The area of this rectangle is fx times dx, which represents the probability that a random number is between capital X and capital X plus dx in this small region. So that's the probability density function. And given that this is the probability density, we have these two formulas. So you can convert CDF to a PDF or a PDF. If you take the integral, you get the function to convert PDF to a CDF. So these two can be converted for a given distribution. And fx is always an increasing function of x, given that probability density is always non-negative. So you can see that if fx is non-negative, then fx, capital Fx is going to be increasing in x. And the capital X starts with 0 and converges to 1. So let's use normal distribution as an example. So the upper panel shows you the density function, and the lower panel shows you the cumulative distribution function. So you can see that cumulative distribution function on the left-hand side, it should converge to 0 because f minus infinity is 0. On the right-hand side, it should converge to 1 because f plus infinity is 1. And in between, it's an increasing function. So that's what CDF looks like. For PDF, for normal distribution, you're gonna have that picture. So what's the total area below the PDF? It should be 1, thank you. Because the total area is basically an integral of, you can think about, take the sum of all these small rectangles, which is the integral of the PDF. That should be converges to f plus infinity, which is 1. Now, given the PDF and CDF, we can define the value at risk. So we will use the distribution. First of all, we will use the distribution to model the loss of your portfolio, because we want to estimate the aggregate loss of the portfolio. Now, given the model, we're going to have a distribution of the loss. So the x-axis on the left-hand side, let's call it loss. Loss as a positive number, and right-hand side is the gain. Okay? Loss is minus gain, basically, equals to minus gain. So this is a PDF. From a PDF, the value at risk, X% value at risk, X% value at risk, X is the confidence level. So x, for example, x can be 99%. So value at risk is this loss such that the area, this red area, what is this area, red area? How do you interpret it? So this red area represents the probability that your loss is greater than this value. Okay. According to, again, here, okay, you can think about this is the rectangle. Okay. So this red area, you can actually break them into very small, many rectangles. And each rectangle represents the probability that loss will be in this region, and this region, and so on. So if you take the sum of all of those, you will get the area of this entire rectangle. This is going to be the probability that your loss is going to be greater than this value. Let's call it the value at risk. If you take the sum of it, and that's how, yes.
So if like the regular PDF is taking the probability to the left, is that like a -1 minus the probability to the left type of thing to get there?
Yes, so this area should have a probability of 100 minus x. Okay, because the total area should be 1, so this is 100, this is x. The white area is x.
Okay.
This small area is 100 minus x. The total is 1. Total, the sum of the two areas. So if your x equals to 99, for example, this red area should be 1%. You can imagine that for value at risk of 99%, that's the loss. That's kind of like the cutoff. You can think about that. Your loss, the probability, the loss greater than this value at risk is less than 1%. Okay. So that's how we can solve value at risk based on the PDF, the probability density. Now, let's look at two examples. So, the first example, the gain from a portfolio during 6 months is normally distributed with a mean of 2 and standard deviation of 10. What is the 99% value at risk after 6 months? Because of the limited time, let me just show you the results. So the most important part in this example is that you have to define the direction of this x-axis. Usually we will define that as loss. If it's a loss, and the gain of the portfolio has a mean of 2, so the $2 million gain represents minus $2 million loss. So this is going to be a loss distribution. So you solve for value risk, you need to find the loss distribution. Now we want to solve for the 99% value at risk for after 6 months. We need to use this number. Actually, this is the inverse cumulative normal of 1%. What is the inverse cumulative normal of 1%? That basically means that the cumulative function, normal function of minus 2.326 equals to 1%. Or given the cumulative probability distribution function, the probability standard normal variable, that's called epsilon, less than minus 2.326 equals 1%. This is standard normal. Now we want to solve for the value at risk such that this area is 1%. According to the previous slide. Now, we know that for a standard normal, this is standard normal, which means that has mean of 0 and a standard deviation of 1. The probability that a standard normal variable less than minus 2.326 is 1%. So we can solve for, because now we want to solve for the right tail of the distribution. So this is going to be 2.326 because it's symmetric normal distribution. So that's 2.326 for standard normal. For this non-standard normal, you can convert it by using the mean plus, so I guess I can give you a kind of formula to do here. The mean is minus 2, and the standard deviation is
10.
10, thank you, times this number. So that's going to be the your 99% value risk. I know, I mean, if you're not very familiar with normal distribution, this will not be, if you're not very familiar with all these features of normal distribution, it may not be easy to follow this. But you don't have to worry about it because later on I'm going to give you a formula. You just, once you know the expected loss and the volatility of loss, you can just throw into that formula. You'll be able to get the value at risk. Okay, so you don't have to do all this once we have the formula. At this stage, I just want to show you an example about applying this method to estimate value risk. Later, we will talk about another method which is based on cumulative distribution function. Now, here is another example I want to talk about because this has nothing to do about all these different features of normal distribution. This is a uniform distribution. So uniform distribution is is a distribution that's even easier than normal. So all out. Let's look at this question. All outcomes between a loss of 50 million and a gain of 50 million are equal likely for a 1-year project. What is the 99% failure risk? So uniform distribution basically is a distribution based on for example, you for two numbers A and B. So it's a random number x between A and B, two numbers. And any number between A and B are equal likely. This is called uniform distribution. Now, let's look at this example. So let's spend like 5 minutes to think about this one. So first of all, because we have talked about the probability density function, I want you to think about how can I draw the density function of this loss distribution. And once you draw the density function, how can you solve for the value of risk? So by density function, I mean picture like this. Any idea how to draw what the density function will look like?
This could be a rectangular box.
It's a box. Thanks. So the loss. Okay, let's draw the picture together. So minus the loss can be minus 50.
Minus
to
50 equal positive 50.
Yeah. Minus 50 to plus 50. And this is uniform distribution, which means that any number between minus 50 and positive 50 will share the same probability. They're equal likely, which means the density will be a constant. So, if you, for example, the reason that this is a constant because any of these rectangles, you can think about any rectangles of this small region of DL should have the same area. Because that area represents the probability in this small region. As I said, this is equal likely, so they should have the same area. And what is the value of this? No, 99% value of this. So according to our previous picture, we need to solve for this area. Oh no, not solve for this area, but we want to solve for this value so that this shaded area is 1%. And of course, the rest is 99%. So then the rest is just geometry. You have minus 50 plus 50, so this is, this side of the box is 100. The total area is 1, because that's probability, the total area is 1. So this side is 0.01. If that side is 0.01, now you look at the smaller rectangle, which has the area of 0.01. So you can solve for, I guess you can solve for this side of the smaller rectangle. It should be 1. Because if you look at the small rectangle, this side is 0.01, and times this side should be the total area, shaded area, which is 0.01, so this side should be 1. If this side should be 1, so VAR is going to be 50 minus 1, which is 49. This is the 99%. So this has nothing to do with this, all these features of normal distribution. This is just a very straightforward uniform distribution. You can directly see how we can solve for the value at risk using the density function. And we can solve for the value at risk using the cumulative distribution function as well. So it's more straightforward if you use a cumulative distribution function. Now, if x-axis is the loss and this curve represents the cumulative distribution function, right? Because on the left-hand side it converges to 0, right side should converge to 1, and it's monotonically increasing. So value at risk is going to be the loss that corresponds to the CDF equals X%. X is your confidence level. So for example, 99%, you can solve for the value at risk by finding the corresponding at loss associated with this cumulative loss distribution function. The reason is because according to the cumulative loss distribution function, probability, the CDF, it's called FL, is gonna be the probability loss is gonna be less or equal to the VAR. So that's exactly the definition of VAR. So you're 90, for example, if X equals to 99, you're at 99% sure that the loss will be less than the VAR. So you can directly solve it. Let's take a break.
Oh, yeah, I got a routine. Yeah, I got like 10 out of 15. Yeah, because I tried my best. Yeah, so I had no resources. Yeah.
You got problem with
What?
with high question.
I got COT. What else did I get? I got bond questions, obviously. Then I got 2 true or falses, and then I got the one with the heads, tails, and then like the different probabilities. That's where I kind of like messed up. Yeah, but yeah, I should be fine after the retake. Yeah.
Yeah, I wonder if he's gonna give a retake like same question on the question.
Oh. Who knows? Probably. He seems like he don't care.
Let's find out, figure out next week.
Yeah, I remember my questions, so I'm going over them now, and then I should be good for the retake. Yeah.
Ask me if you need anything.
Thank you.
It's optional. Yeah, you don't have to do it. I don't know. Just teach me so stressful. I want to read it.
dimension.
That is the place you wanna walk.
Ah, yeah.
So when I saw it, I said, Bali and trees, it was pioneered by JP Morgan. I said, wow. That's nice. No wonder the guy is so. That is really.
Yeah, I have to.
I don't know he gonna give us like the same question from last time or he gonna change.
Page 6.
I don't know if I'm gonna say it, I don't think it's worth. Cause I thought it's just so stressful.
Yeah, my heart was beating fast.
Like I couldn't concentrate, I was like, I need to do something.
Yo, when this dude got up, I was like, oh, yeah, I'm cooked, bro. Yeah, I don't know.
That was cool.
That one got a 100 in 130 minutes.
Yeah.
No, wait, no. No, what are the first people got 100? I got a 73. I thought I had to quit that.
I think I got.
London, I got 11 questions right. So 73.
I was not.
I swear to you. The higher one, and then we keep the higher score.
Central women problem, cause I think that in.
Oh, I
And I didn't get a single.
I got that one, but mine is something off. So I chose the closest one. Yeah. I'm like, if I'm doing these,
Yeah, but that has been something.
But I think he's just doing that in case like people do it on R or something.
Yeah.
It's not gonna be like completely accurate.
I got one of the, you know, like the key for something to do with people.
yeah, that's the CL, that's low key the CL, what I did for the CLT. I like did it by hand. You
And then
find like
you
the standard deviation and stuff,
Yeah.
and then you just put that in this.
Like that's like the last step. But you need to use P1 or else like.
You can't do it, yeah.
I think my question is, I got so many probability questions, it's like, you have two boxes, I'm like, oh my god. I got so many of those. Yes.
What about you?
The two, I got two different questions, and then a different box question.
Are you gonna retake it? Yes.
Aw.
Like it was the exact numbers too.
Because I was scared like he was gonna put those answers on purpose, so I think
I thought it was too easy.
I think
I'm
I'll
like,
leave
wait,
sharp
there's gotta
two.
be some sort of like trick to this.
I
There's
think
no way.
I can't.
There's no way to see.
I can't even focus, I'm so tired.
Would you get late?
Definitely can't
Would you
answer
get
those.
Like yesterday, what did you get on the end? That's good. I plead the fifth. I'm not even gonna say anything. Yeah.
I mean, it's nice to get the last question taken, because in the beginning of the semester, I was like, this guy, he's out for blood, like, he doesn't want us to do well, like.
No, I think, yeah. I think he kind of wants us to pass.
Yeah,
And,
he
yeah.
seems pretty chill. He does, yeah. But imagine if it was on lockdown.
Oh yeah. I mean, it didn't make a difference because I didn't really. I don't know.
But I'm just
No,
saying, like.
honestly, I was not even getting access.
Like, no,
It's like
just
my
lockdown
system
in
was
general,
locked
like,
down.
that puts you in a different kind of state of mind. Like,
Yeah.
I mean, you don't have to do it. Yeah,
Yeah.
no, that's why he did that. Yeah, but I had to go back, I took a bunch of notes, I keep my notes in on.
Did you guys know how to do it? Did you guys get a question where it said, find the convexity for a bond paying $1 for 3 years?
Yeah.
How did you solve that one?
Straight nonsense.
Oh, you.
Yeah, I get it wrong.
Do you know how
That
to
was,
solve it?
I don't know what I did. I have no idea. I can't even.
Oh, now you do? How they
Wait,
they
did
can
you
tell
release
you?
the answers? No, I'm just,
Oh.
yeah, that you can, no,
It's literally you get
It's way
like
than-
you get 3 years, $1 for 3 years, no principal and no yield. So like how do you?
yeah, because there's no yield, so I was like, how are you supposed to calculate the next yield? Sorry.
How do you do it? So I get this. So years, cash flow, and then what do you do 1, 2, 2? And what is this convexity here?
Yeah.
Okay. Okay. And that's the answer? Are you sure? Because when I was looking at my exam, I had like 1-digit answer.
That's the bit that is yesterday I had got this one and then I had to for this 2 days. But then
Oh, okay.
this is the key difference.
So you said you sum these right here?
Yeah.
So what, 14? And then what do you do from there?
This is like the answer.
14? 14 is the answer?
I don't get it yesterday.
Oh. Alright. Because I remember the answers that were available were all like 1 digit. Were like 4, like 4.6, yeah. I remember like clearly, yeah. So I didn't get, yeah, it was like 4.66. 3 point something.
I think that was a 4.67. That was it?
Oh, I think you might divide by 3. And then that'll be like 4.66. 4 point something, right?
Yes. So that's
I knew there was a missing step. I'm just kidding.
What? So you got it,
Yeah, I got it. Yeah, I think I got that one wrong. Yeah. But I think that was the answer, yeah.
Do you think he's gonna change the questions for a reason?
I think so.
I don't think so because you get, since he already has a variety of questions like from 22, I don't think he's gonna.
So
Worst case, either just-
we can also solve for value at risk based on the cumulative distribution function. Now, let's apply it to this example again. Uniform distribution. What is going to be the cumulative loss function? So you need to draw the cumulative loss function. And we can solve for value at risk.
Just gonna have a triangle? Just gonna have a triangle?
Say it again?
You're just gonna have a triangle for the loss?
Yes, we're gonna have a triangle, yeah. Now, I'm just gonna show you this triangle, but you may like to solve it. Let me just draw the triangle first. So, cumulative loss function, right? So we talk about the cumulative distribution function. This loss could be minus 50 to plus 50 equal probability. Cumulative distribution function, right? On the left-hand side again, it starts with 0 because there's no probability, there's no possibility that the loss is gonna be less than minus 50. It's gonna be between minus 50 and plus 50. So this part is 0, probability of this part. And obviously the probability loss will always less than 50 is gonna be 1. So on this side, it's gonna be flat, 2. Cumulative distribution, loss distribution will be flat as 1, at 1, on the loss greater than 50, because the probability in this region is 0, so they already reached 100% at this point. Okay. Between minus 50 and plus 50, there are equal likely so it's going to be a straight line connecting these two dots, because for any point cumulative distribution function, the changes in cumulative distribution function, this is the change. The changes in cumulative distribution function represents the density of the probability in this region. And it is a constant. It's equal likely, therefore the density is a constant. Probability is equal likely. So the slope is a constant. That's why it's a straight line. Okay? This is the CDF for uniform distribution. Now, I want you to spend a few minutes on solving the 99% VAR using this picture. So obviously the 99 VAR is going to be, somewhere here, but how do we solve for it? So what's the other risk? It should be the same as the previous problem, previous solution. Yeah, 49. Yeah. It's just different way to solve it, but you should get the same result. So according to the definition that of the VAR on CDF, this should be 0.99. So the cumulative loss distribution function for the VAR should be exactly equals to 0.99. Which is still constant. Now how do you solve it? You need to, well, this is some kind of a geometry, right? So you have these triangles. You have these similar triangles. So A, B, C, and A, B, E are similar triangles. So you can solve it. So we have this ratio BC divided by DE should be the same as AC divided by AE. So BC is 9.99, DE is 1, AC is VAR plus 50, AE is 100. So you can solve for VAR, which is 49. It's very unlikely in practice you will see these kind of problems based on uniform distribution, but these I just want to show you using this example because you don't, in these examples you're not going to be involved with those features of normal distribution, so it's much clearer to show these two approaches. One is to solve for VAR based on PDF, and the other is to solve for VAR based on CDF. In both approaches, we solve this problem using both approaches, and we got the same result. Okay, so you can clearly see how we can solve for the loss distribution. How do we solve the VAR based on any distribution? Now we're going to look at a much more important example. It's called a discrete distribution. So the previous examples about normal distribution and the uniform distribution are continuous distributions. Now we're going to look at discrete distributions. So let's look at this example. So there is a 1-year project which has a 98% chance of gain of 2 million, 1.5% chance of loss of 4 million, 0.5 chance of loss of 10. We want to solve for the VAR with a confidence level of 99 and 99.9. So I'm gonna solve this problem. This is a very important example. Next week we're going to talk about historical simulation. It's purely based on this example. So this is the example that the problem that we can face in practice. So let's start with the cumulative loss distribution. x-axis is the loss. There are three states, three possible scenarios. That's why we call the discrete distribution. You only have three. In normal distribution and this uniform distribution, you have an infinite number of scenarios. So the first one is a gain of 2 million. That means minus 2 million loss. This is the first scenario. The second scenario is loss of 4 million. And the last one is loss of 10. You have these three scenarios. We need to draw the cumulative loss distribution. Which is basically the CDF. So again, the CDF on the left-hand side will start with 0.
Professor, can I ask another Fourier question? Why AC equal Y plus 50? I thought Y is equal CE.
AC is minus 50, so to 0, this is 50. This part is VAR.
I
Right,
thought
so 0 plus 50.
So it's in this side, right? The left side, right? The bar, the side of the bar is.
You can use 50 plus VAR.
Yeah, but I confused from the previous question because bar you calculate it from the bar to the left. It's mean like CE in the CE.
CE. Okay, yeah.
On the previous question.
In the previous one, the previous solution. Yeah, the previous one we used the density function to solve it. So you can also calculate CE here too. I mean, here I want to use this feature of the similar triangles. So this ratio should be the same. BC divided by DE should be AC divided by AE on this side. So BC is 99, DE is 1, AC is basically 50 plus VAR. Okay, so AE is 50 plus 50, which is 100. So then I solve this equation, I can get the same result. The previous one is based on that density function. You can solve for CE, which is 1. Here, 49, you can also solve for CE, which is also 1. Okay, let's go back to this one. This cumulative loss distribution. So it should start with 0. Because the cumulative distribution basically means that this area basically means that the probability in this area is 0, so it keeps stay at 0. And only until we reach minus 2, there is a 98% probability that my loss will be minus 2, which is a gain of 2 million. So the cumulative distribution function will jump up to 98%. The probability will jump to 98% because the change in this cumulative distribution function is exactly the probability of this number. Probability of this number, of this loss is 98%. So the change, the cumulative loss distribution will increase by 98%. And then it will stay at 98% because the probability between minus 2 and 4 is 0. So there is no change in the cumulative loss distribution. And then, once we reach 4, it will jump again.
99.5.
1.5%, thanks. 1.5%. By 1.5%, so that's 99.5. So you see why we call it cumulative probability, right? So it's basically, for any point in time, it's basically the sum of probability on the right side, on the left side. So it's 98 plus this 1.5, that's now the cumulative probability. And then it remain a flat because there's zero probability between 4 and 10, and it will jump again to 100. And then after that, it's going to be flat at 100. Okay? So this is the cumulative loss distribution. There are 3 possible scenarios. And now we can solve for value risk. So what's the 99% value risk? 99% value risk, once you have this cumulative distribution function, you can solve for the value risk. 99% is, right, you find 99% on the y-axis. Now you go to the cumulative distribution function and find the corresponding loss. It's 4. So the VAR is 4. That's going to be my next slide. The next question, 99.9. What is the 99.9% value risk?
10.
10. So you basically find 99.9, which is between 99.5 and 100. That's gonna be, so it's 10. How about 99.5? I don't think it's well defined in this case because 99.5 could be either 4 or 10. Okay, on the textbook, the author defined it as 4 plus 10 divided by 2, which is 7. That's okay, I guess. Okay. If you're on the conservative side, I guess you can say it's 10. Let's say, if, for example, if you're a regulator, you're probably gonna say it's 10, so you have to be more careful. Okay, so this example is important, okay? Later on we will have these, we will estimate the VAR based on some financial data, and financial data you're gonna have these daily prices, daily losses. Therefore, you basically have a discrete distribution, but it's just a discrete distribution. Like 5 instead of 3 scenarios, we will have 500 scenarios. So that's why we need Excel. But the idea to solve for VAR is the same as this example. So. The advantage of VAR, so you see that it captures an important aspect of risk in a single number. It is easy to understand, and they try to answer this very simple question: how bad can things get? And all the senior manager want the answer. What's your maximum loss, right? So, but there is a potential problem for VAR. So let's see the problem, what the problem is. Suppose that a bank tells a trader that one day 99% of VAR of the trader's portfolio must be limited to 10 million. You can do whatever you want, but your value at risk must be less than 10 million. So you have to be 99% sure that the loss will be less than 10. Otherwise, that's too much risk. Okay. A trader, well, you know, the trader has different incentive usually. So they want to make more profit rather than controlling for risk. But of course, they are kind of regulated by this risk management team. Okay. So the trader has to limit their value at risk to 9 million. So they create a portfolio where there is a 99.1% chance that daily loss is less than 10, but there's a 0.9% chance that it's 500 million. Do you think that's acceptable?
Kind of defeats the purpose.
Mm-hmm.
It kind of defeats the purpose.
Yeah, I can show you that the trader's portfolio is gonna have a value at risk which is less than 10. But if you ask any manager, right, so this is too much risk. 500 million, 0.9% chance of 500 million, that's just too much risk. So what is the issue here? The issue is this VAR risk measure. It's not a good measure in this sense. It doesn't fully capture the risk of the portfolio. So first of all, I'm going to show you that this is going to satisfy the VAR. So some of you may probably already figure that out, that the portfolio satisfies the VAR, but I'm going to show you, many of you are going to show you this. Okay, so this portfolio, if you draw the cumulative loss distribution function, so cumulative, this is going to be the kind of like, the cumulative distribution function will be look like this, I guess, roughly like this. So on the left-hand side converges to 0, on the right-hand side it goes to 1, but there is a 0.9% chance that loss will be 500 million, and 99.1% chance that the VAR, 99.1% VAR is going to be 10 million, because this is an increasing function, so 99% value risk is going to be slightly less than 10. Okay, so it satisfies the requirement. But the risk is unbearable, so unacceptable. So this type of behavior trader is not as unlikely as they seem. Okay, many trading strategies give a high probability of good returns and small probability of a huge loss. Okay, think about this selling earthquake insurance, deposit money put. So these are, right? Think about the selling earthquake, for example. Earthquake, certain kind of earthquake is like once in 100 years. So the probability of such earthquake is very, very, very small. However, if it happens, you're gonna face a huge loss, just like in this trader's portfolio. There is a very small probability of huge losses. And this is not acceptable. But we keep hearing about this kind of news from Wall Street. Okay, some traders lost a lot of money. They make money for many, many years and then lost a lot of money. So in order to fix this problem, we have this new risk measure. It's called expected shortfall. So VAR is the loss level that will not exceed with a specified probability. It answers question like how bad can things get? Expected shortfall is the expected loss given that loss is greater than the VAR level. So if things do get bad, what is the expected loss? So it's also called conditional value risk or conditional tail expectation or expected loss. two portfolio with the same VAR can have very different expected shortfall. So I'm going to show you what the expected shortfall is. Okay, so let's look at the upper picture. So this is x-axis is the loss, and this blue line, this curve represents the cumulative. The probability density function. So this is going to be your VAR, such that this area, right, represents 100 minus your confidence level. The expected shortfall is the average loss in this small region, okay, in this area. That is the expected shortfall, the average loss, not the cutoff here. So let's look at example here. So I have two portfolios. For the first portfolio, the loss of the first portfolio is gonna follow this distribution. The loss of the second portfolio is gonna follow the distribution below. And the value at risk of this distribution of these two portfolios are exactly the same. The difference between these two portfolios, the loss of this portfolio is obviously this spike here, okay, with a relatively small probability of huge spike. This represents a large probability with a huge loss, okay? So on this side is the loss, so huge loss. Which portfolio is more risky? The lower one, right? The bottom one. But the value at risk are the same. Which one has a higher expected shortfall? The expected shortfall is the average loss in this area. Right? So the expected shortfall therefore is the average loss. You can see that obviously for the lower figure, the expected shortfall is higher. So in this sense, the lower portfolio is more risky, but the value at risk is the same as the upper portfolio. Therefore, value at risk doesn't really capture this kind of risk in this portfolio. Therefore, we need the expected shortfall. So expected shortfall in the lower figure is higher than the upper figure in the upper portfolio. So if you set the expected shortfall limit rather than VR limit for the trader, it's less likely that they will be able to take this kind of position. That's where the expected shortfall is more useful. So let's solve for the same problem. This discrete distribution. We want to solve for the expected shortfall of 99%. Think about it for maybe 3 minutes. So expected shortfall is an average loss. What's the expected shortfall? Any? Okay, let's look at this together. So we want to solve for the 99% expected shortfall. So this is gonna be the average loss. Conditional on that loss is gonna be greater than value at risk. This is how we write it. Expected L is the average loss when loss greater than value at risk. So you first need to find the 99% value at risk. We already did that, which is 4. Okay, that's where the cutoff is. And 99% VAR is going to be the average loss when loss is greater than the value at risk. So that's going to be in this region, inside this circle. There are 2 scenarios. There are 2 possibilities. One is 10, and the other is 4. So the probability of 10 is 0.1%. Probability of 4, right? This is how we compute the expectation. The probability of 4 million loss is also 0.5. This is 0.5%. This is also 0.5%. Even though, now you have to be careful, even though the loss for the probability of loss equal to 4 is 1.5%, you only include that part which is greater than the value at risk. So in that 99%, so it's only 0.5. That's above 99%. You only include the part which is higher than 99%. That's how the 99% is. So 0.5 times 10, 0.5 times 4. And you have to divide it by the total probability of this region, which is 1%. So this is the conditional probability. So that's kind of like the average of 10 and 4, so it's 7. Okay, the expected shortfall is 7. So how do we use VAR. So how do we use these measures? First, it gives us an idea about my maximum loss, and the regulator will also set the capital requirement based on VAR. So to give you a simple idea here, a simple example to give you the idea here, that suppose that the VAR portfolio for a confidence level of 99.9% and a horizon of 1 year is 50 million. So let's say that this portfolio is the total asset of a bank, represents the total asset of a bank. If a bank keeps 50 million in equity capital, so there is only 99.9% probability so it will not run out of equity capital over a year with the probability of 99.9%. There's only a very small probability, right? Because that's the maximum, that's the loss. That the loss greater than 50 million is less than 0.1%. And if you have 50 million equity capital, right, the probability that you're running out of equity capital is going to be 0.1%. So the bank default probability is only 0.1%. So that's roughly the idea. Okay, we will talk about this Basel framework. It will be based on this VAR estimates. Some of those requirements will be based on this. There are some other requirements too, but some of it will be based on the VAR estimates. Because you can kind of imply the equity capital that you need for to limit the default probability of a bank. So we want to design a risk measure that will equal to capital a financial institution is required to keep. This is called the coherent risk measures. So there are 4 important properties of this coherent risk measure. So this is how mathematicians do this. Okay, so they define some features and make sure that you satisfy these features. So let's go through them. Monotonicity. So there are 4 features here that a risk measure has to satisfy. So so far we talked about 2 risk measures. One is, we talked about 3. One is volatility. Now we talk about VAR and expected shortfall. So monotonicity. If one portfolio always produces a worse outcome than another, its risk measure should be greater. This is very obvious. Translation invariance. If we add an amount of cash, K, into a portfolio, its risk measure should go down by K. This makes sense too, because cash is kind of a buffer for the losses, right? So if your risk measures the loss, and you add K dollars into your portfolio, you should reduce your loss by K dollars. Okay, so that's what it means. Basically, the cash as a buffer here. Homogeneity. So changing in the size of portfolio by lambda should result in the risk measure being multiplied by lambda. Well, I guess you can think about like I have a portfolio. If I have $100 in this portfolio, and my value at risk, let's call it, I have like $10 value at risk. Now, if I have $1,000 in this portfolio, same portfolio, if I invest $1,000 in this portfolio, my value at risk, my risk should go up by 10 times, right? Because my total investment increased by 10 times. So my risk measure should be multiplied by 10 too. The last one is self-additivity. So the risk measure for two portfolios after they have been merged should be no greater than the sum of the risk measure before they were merged. This is so because this is like what we call diversification. Okay. So if you have these two portfolios, as long as they are not perfectly correlated, right? So the sum of the risk measure for each one should be greater than the risk measure if you put them to a portfolio, because when you put them into a portfolio, single portfolio, you should get some diversification and risk should be lower. So these are the four. I'm gonna show you that basically the value at risk is not a coherent risk measure, but the expected shortfall is a coherent risk measure. We're gonna look at this example. Okay. Let's take a break. Another break.
You want me to take it though? Yeah, I know.
But like, my question was harder. He's asking me what is the virus of first row.
Yeah, I have even the first and the second.
Yeah, like he's asking what is the co-virus of first row and second row, and like one question is what is the virus of first row.
Just because he knew also when the value, but this is 0, 1 or something, we can forget that.
That's I have no idea about it.
Me neither, so.
I really. So I was like trying to
I was stupid at doing that, so I wrote down the question.
Try to solve with the fake
Yeah, I wrote down the question. These are the questions.
I have some question for you. You can answer every question of the professor. Did you learn it before?
I also got this.
I'm just old.
Oh yeah. You know everything. You're amazing.
No, I did the modeling courses. You guys didn't. You could take 2 courses at a time, or you could take 1 course at a time in the program. So I did all the modeling courses last year.
Modeling question. Modeling.
We won Yakov's class, then you're going to take hang bys in the spring, then Ed Harris teaches one over the summer. So it's 3 modeling classes. So I've seen some of this stuff before.
And I think you have like experience to work on this stuff before. Did you?
I'm actually an engineer.
Everything here is this is new to me. But yeah. Thanks for your it's very helpful, especially for like international student like me. During lecture, I can like understand 60-70%, but if I can rewatch this again at home, I can fully understand it and learn more vocabulary, new word of English. So that's very helpful. Thank you.
If you go back in time, you'll see it. I put all the summer lectures when I taped them, about halfway through hang by stuff. This one I started taping mine, so he didn't care because other people were already taping the stuff. So you see some. He uses R next semester, so get used to hang by. He uses R. So learn how to use R before you start playing. Though Yakov uses R too, so you've seen some of it. Yakov is teaching again in the spring.
Yeah, we just finished Yakov midterm test last night.
But he's teaching in the fall and the spring again.
Yeah.
He's going to do the fixed income course.
Fixed income class.
You can register for class already if you haven't done it already.
But I like Yakov. I learned a lot from him.
Yeah, he's funny.
Yeah, funny, brilliant. Can you say his name again? The guy you said that the artist. The guy you said that your favorite one. His name?
Hang by is going to teach modeling too.
Hang by.
Yeah. And Ed Harris teaches modeling 3 over the summer.
Harris.
Ed Harris, yeah.
I have to take this. Hang by.
He's teaching another course in the spring, but it's at the same time you're modeling. Modeling 2 courses. So you can take it. But if you on the 5-semester plan, you'll take his courses again in the following spring.
Are you planning to take the 5th semester?
Yeah, I'll take it.
I'm thinking too.
What are you guys working on?
Oh, he also wants me to.
Need to apply for a scholarship to learn that semester.
Is it yours are similar with him or?
Yeah, variations.
Okay.
What Connecticut does, if you're a resident and you're over 62, you take state college and stuff
maybe-
for free.
Maybe I
Oh
share with
my
you
God.
and
You just have to pay the fees, but
she-
tuition's free.
Simple,
Oh,
maybe for another one.
For me,
I
my
share
tuition,
on Gmail.
17,000
Yeah, 'cause this was 1,500 a course, this program.
Yeah. 1,500 for credit.
Yeah, credit, yeah.
And Harris. Harris.
So do you mind if I ask some of the question? Can you have this one? This one? The four and between X1 and X2? Do you know how to do it?
And at Harris over summer, we'll use Python, so get used to Python.
Python? Which one you like the most, R or Python?
I started with R, so I was more familiar with it, but after I've been doing more with Python now, I'm getting more used to Python.
Wow.
Really?
From your experience, you think Python and R, which one you can apply to like
They
on a
both
job
work.
market?
They both work. You have to learn both of them, but Python is more accepted in industry now.
So if like we can earn a certificate of Python, it's more like legit and stand out, right?
There is a Python course. It actually is both in the spring,
Oh, really?
but
Bring-
they're part of the economics program.
So they're not gonna give us like separate certificate for that skill.
No, you would just take like a regular course here.
Yeah, yeah.
But the problem is, the way your program is, the FRM program, they charge you for each course you take. So I don't know if you want to do that. That'd be another $4,500. So, but if that's the best way you're gonna learn it, then it may be worth doing. But otherwise, if you're, because normally you just pay full-time tuition once you're outside the school of business, and regardless of how many courses you take.
Regardless.
Yeah, if you say you're in you're in the economics program, you can take 5 courses and just pay full-time tuition.
Yeah.
Versus in the school of business, they charge you for each course that you take.
Yes.
And for this program, it's $1,500 per credit.
Yeah, yeah, yeah.
So that's what's not too cool about what they do in the school of business.
Yeah, but in your because we are international student, we have like required minimum of 9 credit per
Yeah.
semester. So I cannot do that. I cannot take like 5 scores a semester. Then another score. I don't have enough courses to stay here
Yeah.
in another semester. So I just follow the schedule.
Well, it's a STEM program, so you get 2 years.
Yes, 2 years. My visa just valid here just for 2
Doesn't
years.
work for WhatsApp, but I sent
You can get extended. Though.
Yes. I'm planning to get like a SIE license and Series 6 and Series 7 instead to be able to work at the bank.
Look at Series 66 too.
Yeah, Series 66.
That's another one that the banks want.
Yeah, Series 66 and Series 7
Yeah.
SIE. Triple.
And start looking at the CFA program.
Yeah. We are looking for like to apply to have a level 1, the first level of CFI.
As a foreign person, you really want to get up to level 2 by the time you work. An American student will get a job with CFA level 1. A foreign student, you're going to need level 2 to get a job. So,
So as a student, I have to get level 1 and
yeah.
at work level 2.
You don't have to do level 1 for school.
Mm-hmm.
They don't push that here, but it's going to be almost essential for you to get a job. Even an American student will have trouble getting a job without the level 1 certification.
Yes.
And one of the guys where I came from, he said, for a foreign student to get a job in the States, you really got to have level 2 CFA certification.
Did you earn that before?
No, I haven't done that. I haven't had to, but I may do it eventually.
How about CFP?
What?
CFP or financial, Chartered Financial Planner.
No, I haven't done that. My background is engineering more than anything else. I've done a couple of things. I've worked as an RN. I ran ICU for a while, and I went back up to UConn for chemical engineering after that. So I was up at stores from like 2000 to 2009.
Okay,
Wow.
let's look at this example.
Nice to talk to you.
So I'm going to show you that the VAR does not satisfy the fourth one, which is the subadditivity. Okay, and using this example, more importantly is I want to show you how to solve for the VAR in this kind of question. I'm going to show you two approaches. Okay. There are two independent projects, which has a probability of 2% of a loss of 10 million and 98% of loss of 1 million. And you can easily find that 97.5% VAR for one project is 1 million. So let's start with the approach that we already learned. So we are going to draw the cumulative loss distribution. So let's start with one project. So there's this one project. For one project, there is a 98% loss of 1 million. There is a 98% loss of 1 million and a 0.2% loss of 10. Two scenarios, discrete distribution. So you can draw the cumulative loss distribution. This is 98, and that is 100. What is 97.5? Value of risk. 41 million. So you find 97.5. Now let's look at the portfolio. So for the portfolio of these two projects, we want to solve for the 97.5% VAR. 2. because each project has 2 scenarios, so in total, we will have 4 scenarios. So let's look at the project. Let's call it project A and project B. And for project A, there are 2 scenarios, 1 and 10, loss equals to 1 and 10. So these are the 4 possible combinations of scenarios for these 2 projects in total. So you can compute the portfolio. Let's call it total. So for the first scenario, the total loss is 2. This is going to be 11, 11, and 1. The loss of the portfolio. Now we also need to compute the probability of each scenario. In fact, we can combine these 2 into a single scenario. So we're going to have 3, because the loss of these 2 scenarios are the same. So the probability of $1 million loss is 2%. And let's assume that these 2 projects are independent, so the total probability of these 2 is 0.02 times 0.02, which is 0.0004. And for these 2 scenarios, for each one of them, I'm gonna have 0.02 times, so 0.02 is the probability of 1 million, the probability of 10 million is 0.98, and now I have 2 of them, so the total probability is 0.0392. The last one, 20, the probability of $10 million loss is 0.02. Oh, sorry, that was wrong. So this is 98. So that is 0.9604. So 3 scenarios. So for the portfolio, there are 3 scenarios with these 3 probabilities. So you can take the sum of these 3 probability. You can find that the sum equals to 1. Now we can also solve. Now we can draw the cumulative loss distribution. To 11 and 20. The probability of 2 is 0.096. The probability of 2 million loss is 96.04%, and the probability of loss, the cumulative probability for 2 and 11 is going to be the sum of the 2, which is going to be 99.96. The last one is going to be 100. Okay. So what is the 97.5% value risk?
11.
11, thank you. That's gonna be between 96 and 99. That's gonna be 11 million. So you can see, we solve for the value at risk for a single project is 1 million, but the value risk for portfolio of 2 projects is 11. So the sum, which is greater than 1 plus 1, the 97, the sum of the 9 of the AR of each project. So this violates the sub-additivity condition. So it doesn't satisfy the sub-additivity. So it's not a coherent risk measure. There is another approach I want to talk about. As you can imagine, right, so there are only, for the portfolio, for a single project, you have 2 scenarios, but if you have 2 projects, you're gonna have 3 scenarios. What if you have 100 scenarios? We will face that problem next week. Okay, you're gonna have 500 scenarios. You have 500 scenarios, you don't want to draw the cumulative loss distribution. Right? So what can we do? So that's the new approach that I want to talk about. Instead of drawing this cumulative loss distribution, you can start from here for the portfolio. You can do that for a single project as well, but this is, we have more scenario here, so it's easy. I think it's more clear when you use this portfolio. So you still need to create this table to compute. You need to figure out all the scenarios and all the probabilities. And now instead of drawing this picture, you can do something faster. What are you going to do is look at the total loss. You will sort the loss from the highest to the lowest. This is kind of like the Dodge auction. So you sort the loss from highest to lowest, and now you have line was their probability, 0.0392, 0.9604, from highest to lowest. Now let's go back to the definition of VAR. 99%, for example, 99% of VAR represents the top 1 percentile of the loss distribution. Top 1%, highest. That is what VAR is. Because the probability loss greater than VAR is going to be less than 1%. So in that sense, you start from the highest, check the probability, right? This is less than 1%. But this is higher than 1%. So VAR equals to 99% VAR is going to be 11. And what about 90? Oh, we are trying to calculate 97.5. Sorry, 97.5. Same. right? This is less than two. So if, when you calculate 97.5%, you find the top 2.5% loss. Okay. So this is less than 2.5%, but this is higher than 2.5%. So that VAR is 11. Okay. So you don't need to draw the cumulative distribution function anymore. You just find the top losses in the distribution. We will use this later. Now, what about the expected shortfall? So now I want you to solve this. Okay, let's spend 5 minutes. I mean, you should be able to solve this now. What's the 97.5% expected shortfall for a single project and the portfolio? Okay, just because the limited time, actually the answer is on the next page. Okay, it's for the expected shortfall for a single project. This is the loss distribution function. Remember my circle. So whenever you solve for the ES on a cumulative loss distribution function, you can draw a circle. You want to calculate the loss inside the circle. Okay? So for a single project, this means 10 times the probability, which is 98. 10 times 2 is 2%. Plus 1 times, this is 0.5%. You don't include the entire, all the probabilities of these loss equals to 1. You only include that part which belongs to the top, the 2.5%, the top 2.5%. So that's divided by 2.5. And they should be 8.2 million. That's for a single project. For you can do that for portfolio 97.5. Okay, so you solve for the ES. This region, this is 20 times the probability, which is 0.0004 plus 11 times this part, that is that is 2.5 minus 0.00. Divided by this, okay, which is this equation. The reason is because this part is the probability of 20 million loss is 0.0004, which is okay, this area, and this probability of 11 when loss greater than 11 in this 97.5% value at risk would be 2.5 minus this 0.04. You only include that part which is in the top 2.5%. So divided by the 2.5%, you get the ES for the portfolio, which is above 11. So you can see that the expected for this portfolio is less than the sum of the portfolio of the ES for each project. So this, in this case, even though VAR does not satisfy the sub-additivity, the expected for does satisfy it. Okay, so the risk of the portfolio is less than the sum of risk of each project. So this is diversification. So that's it for the discrete distribution. Now let's look at the normal distribution. As I promised at the beginning that there is gonna be a formula. This is the formula. If you're not very familiar with all the features of this normal distribution, you can directly use this formula, but you have to be careful. Okay? This is the formula. Well, if the loss follows a normal distribution, you can use this formula. Value at X%, that's the confidence level. For example, equals to 99, you can directly plug into this formula. You can solve for the value at rest. That's the inverse cumulative normal. Okay? That's a standard function. You can use Excel to solve it. Now, sigma is, now there are two parameters you need to put as the input for this formula. One is sigma. Sigma is the dollar value that the standard deviation of your loss distribution. That is sigma, the standard deviation of your loss. Mu is the mean of your loss. Most of the time, if your value at risk is short horizon, like 3-day, 10-day, even a month, maybe a year. If you look at the risk in the short horizon, mu is 0 because the expected return of any asset in the short term is 0. In the longer term, mu can be different from 0. And you have to be very careful about mu because mu is the expected loss. If you have certain kind of expected gain or expected return, when you plug into this formula, you have to add a minus sign when you use it as a mu. For example, you have $100 in SP 500. Okay, you look at 1 year value at risk. You assume that SP 500 follow a normal distribution. Then, because we believe that SP 500 has a risk of premium over the risk of free rate, therefore, let's assume that the expected return is 8%. If you have $100, your expected gain it's going to be 100 times 8%, which is $8. When you plug in this equation, mu equals to minus 8. Okay, because mu is the expected loss. That's the key when you use this equation. I have to want to emphasize. So again, if you want to solve for expected shortfall, you can use the second equation. Everything is the same as the first one. Okay, so it will be very straightforward. Usually for short horizon, we assume mu equals to 0. Y in the second equation is just the inverse cumulative normal of x. So there is an example here. Suppose that the change in the value of portfolio over 10-day horizon is normal with a mean of 0 and standard deviation of 20 million. We want to solve for the 10-day 99% EAR and expect shortfall given that the inverse cumulative normal of 99 is 2.326. You can directly apply this formula. Okay, 10 days is pretty short horizon. Okay, so mu is 0, so you can directly apply 0 includes mu. And then sigma 20 million, which is standard deviation. Plug in, you can get the value at risk is about 46.5 million. Expected shortfall, mu is 0. It's going to be 43.3. That's the very useful formula. I'm going to stop here. We will continue next week. Thank you.
So that was a CDF.
Yes.
And the PDF starts here.
Yes, small athletes.
Okay, so this part and this part.
Right.
Okay, just a minute.
They gave you your final exam date. They put up your final exam date for this course.
What?
They finally gave you a final exam date for this course.
They do?
Yeah,
When?
the 10th of December. It's on a Wednesday.
No.
I told them to put it in the first week of the. At what time?
6 to 8.
This one?
Yeah, 4:33.
I told them that I wanted to do it on
I'm glad I told you that.
the 3rd. I'll email.
Well, most graduate classes, they do it the last day of the class.
Yeah, I don't know why they. That's usually what we do in the previous years. Thank you. I knew that. I never received any email like this.
Oh, it's just in the schedule.
Oh, okay. Yes.
Well, I wanted to ask on the, is it going to be like, we're gonna be answering on a sheet, or we're gonna be using our computers to answer?
For the exam, no computer.
Also, it's gonna be as right here.
Anything we can bring to the classroom on final exam?
You can use a calculator.
We have like a sheet.
You have formula sheet. I'll prepare a formula sheet which you need. Then you have a calculator. No computer.
How many questions
I have no idea yet. Because I haven't taken it yet. Yeah, there will be multiple choices.
Oh, they're gonna be more.
Yeah, I made a mistake actually.
They're gonna be more.
Sign the